Welcome to Southbound, Retire in South Africa, a guide and companion for anyone looking to call this vibrant nation home. I'm Jeremy Maggs, here to help you navigate through the intricacies of a new life in South Africa. This series, brought to you by Xpatweb, aims to provide invaluable insights and advice for a smooth transition and a successful life here on the southern tip of Africa. In each episode, we'll delve into various aspects of South African life, everything from moving money to immigration and property investment. So whether you're considering a move, already in the process, or just curious, you are in the right place. Stay tuned as we embark on this journey together, uncovering all that South Africa has to offer. In our second episode, moving money, rules, regulations and processes for moving sums of money into South Africa, and of course tax residency. What does it mean? How to achieve it? I'm going to talk to Jerry Botha. He has over 25 years of experience and is a well-respected and leading tax professional in South Africa. Jerry founded Tax Consulting South Africa in 2005 and has become South Africa's largest independent tax practice. So the man knows what he is talking about. Jerry, before we get to the ins and outs, and a very warm welcome to Southbound, when people are considering bringing money into South Africa, what kind of mental space should they be in? What should they be thinking about? What kind of strategy do they need to be considering?
The one thing that's slightly different in South Africa than the rest of the world is we still have a thing called exchange control in South Africa, which means that when money flows into South Africa, it must be correctly classified and it must basically come through a Reserve Bank approval type of process. It does not take long if you do it correctly, but you must set up your bank account correctly. And when the money flows incorrectly, that obviously informs the tax treatment, and that also informs how easy it is for you to get your money out one day when your money needs to flow out.
So we touched on this in episode 1. Let's talk a little bit more then about the classification. What does that mean, and how do people need to approach that?
So I think our exchange control system, it's either got a category that you call South African residents. If you come to retire in South Africa, it's a good idea to not say that you come to retire in South Africa forever and to basically get buried here, because if you do that, you basically become domiciled here or ordinarily resident, and then you become taxable on your worldwide income. And then also your money that comes into South Africa is treated like a resident. That's kind of where you don't want to go ideally. The better route is to say, I'm just coming for retirement here, for example. I still have my health. I want to spend a couple of years here. I'll see what it's like, and then I make up my mind after that. Now, the moment you have not a permanent intention to stay in South Africa indefinitely, you're a non-resident for exchange control. Now, technically, exchange control then do not apply to you, but you still have to go through the admin process. The bank still opens a non-resident account for you. When the money comes in, you will then classify it as non-resident money coming in, and it just basically goes through a clearance process that makes it easier to go out.
How difficult, Jerry, is that process?
Like many things in South Africa or around the world, it is very simple if you do it correctly, and it is very tough if you do it incorrectly. An example is, in every big bank, there is a specialist exchange control team. There's people that understand non-residents. They're often referred to as a non-resident center. If you just walk into the normal branch of a bank, any bank, and says, here I am, I want to open a bank account, you give them the documents, the person who assists you is probably going to open up for you the wrong type of account. Then you have to unwind that. But if your account from day one is a non-res account, then everything kind of stacks up.
You've got to ask then for a setup of a non-res account. How does that differ then from a resident? Is it just by name more than anything else?
It actually within the bank gets treated by a completely different department and team who's then trained in terms of how that should be dealt with. But the moment it's classified as non-resident, then you're speaking to the right department. You can bring your money into South Africa. A big issue then is obviously when you bring dollars, euros, pounds, whatever you bring into South Africa, mostly dollars, I think, you don't have to convert that money to rands like a South African. You can keep it in a dollar facility with a South African bank and then convert it at when timing is right. If somebody comes to South Africa to retire, they either know or they soon come to realize that the South African rand is quite a volatile currency.
Yes, indeed.
I think this year we've moved all the way from probably 15s up to 20s. So that's a 25% swing depending on timing. Typically what you want to do is you want to have your living money in rands, but you kind of want to keep your capital in dollars. And many people that come to South Africa to retire, they just set up the facility in South Africa to obviously cover their living expenses, or if they've got the right to work with that, then obviously they would just keep in South Africa the money to cover their day-to-day expenses. And then, of course, if you want to bring a larger sum of money in, for example, a bit of capital to purchase a property, or perhaps to buy a car, because a lot of foreigners coming to South Africa, they don't qualify for finance, they will just purchase a car outright with cash. You would then just do the conversion to get the rands to make that acquisition.
Many people coming here for the first time will want to bring in large amounts of money. It's the setup process. What risks should they be looking out for in that process? Where are the pitfalls and how do they mitigate against those?
The one risk, obviously, is a timing risk that you need to make sure that you rather start the process sooner rather than later. We can set up a certain non-res account within 24 to 48 hours because we've got direct access to one of the leading banks, for example, just for that conversion reserve bank process. It's not like the UAE where you have to fly there and stay for a week to get a bank account open. It can be done fully remotely. It can be done fully electronically. You can stay wherever you are, and it is all digital that you can basically set up an account.
And this is a service provided by all major banks in South Africa.
It's a service that must be provided by all major banks because the Reserve Bank says for you to be an authorized dealer, you have to provide certain services to customers. Some banks we know is more geared towards that, but I would set up that account immediately. I would make sure that my money flows correctly into the account and it gets cleared for use. And then you can deal with the timing issue. So you don't want to be in a situation where you're in a hurry to convert a large sum. You kind of want to get your timing more or less right.
And that's just watching fluctuations as carefully as possible.
Yeah, it's quite common to say to somebody, this is a good rate. And you just basically advise the bank to say, when it hits that threshold, please trade for me. Because you're not a gambler in terms of money.
It's just a bit of clever hedging.
Just a bit of clever hedging, yeah. And I think then the other part is obviously when the money comes in, you must show the source of funds. In other words, what is it that you're bringing in? Where did it come from? Because there's anti-money laundering laws in South Africa like the rest of the world. South Africa is grey listed at the moment. Many countries are grey listed, and of course we're working out of the grey listing. But that is just basically the fact that you have to have this level of compliance to ensure that you can show where your money is from.
So what type of paperwork would you need in order to declare the source?
Well, I mean, it depends literally on where it comes from. Let's say, for example, you have cashed out a foreign pension plan. They would want to see the statement of the pension plan. They want to see your bank statement that shows how that encashment happened. They want to see the tax that you've paid on it. If you've sold the property proceeds, they want to see the sale agreement perhaps and how that payment was. Perhaps that closing statement of your transferring attorney that shows how it was done. If you're using an inheritance, they perhaps want to see your executor's letter that says your inheritance is X. Here's your $500,000 or $1 million that you've inherited. Every single document you would have a source. If it's a dividend, a sale of a company, you would have a supporting document for that. And these things are not trick questions. We know what the questions are.
I understand that, but unless you have all of that information to hand, it can also become a very onerous and frustrating process to have to deal with. So just make sure that that is right up front. And again, to Xpatweb, the organization offers services in that respect. You spoke about getting to a point where your funds are cleared for use. How long typically would that process take?
If you're well planned, I think your first transfer, give it a week, because you don't know how long it takes from the foreign bank to the South African bank. There's often intermediary banks that gets involved. For example, at the moment, if you're in South Africa, you can't send money from South Africa to Russia. Is there any rule in South Africa that says you can't? No, there's not. Every South African bank is supposed to be able to send money to Russia, but your money has to flow through a global bank, and the switch system, and that sits often, for example, in Europe or in Germany, and that doesn't flow through that channel.
So contingent on the country, but these are important things that people need to bear in mind, because if you don't get that right, you might very well arrive here and you have no money to use, and that is frightening.
First transfer a bit more. After that, once a system is proven, we've got clients that as clockwork, it takes 48 hours from international transfer to clear into their account, because the bank has got the approval and the money flows straight through.
All right, so we've dealt with moving money in. Now comes the next hurdle, and that is tax residency in South Africa. Again, if you were listening to episode 1, Marissa and Keith did touch on that, but Jerry, let's flesh this out a little bit. And again, the obvious question, what does it mean, tax residency, in the context of South Africa?
The concept is global tax residency. If you're a resident in the country, you pay tax on your worldwide income, you pay tax on your worldwide capital gains, you pay tax on your worldwide estate in case of death. You fall subject to tax on things like gift taxes or all sorts of things like that. That's if you're a resident. If you're a non-resident for tax purposes, pretty much none of that applies to you, which we'll talk about later. In the rest of the world, normally, if you spend more than 183 days in a country, you trigger tax residency backdated to day one when you arrived. In South Africa, that rule is completely different. You only become tax resident under the days test in the beginning of your 6th tax year in South Africa. So basically, you can spend for 5 years, 365 days under this days test in South Africa and not become a tax resident. That makes South Africa a very big tax haven for somebody that just wants to come and spend time here, and they don't trigger tax residency. It triggers on the beginning of the 6th year, and that would be 1 March 2020, for example. You know, it's not 6 years from, or beginning of 6 years from when you date you arrive, but beginning of the tax year.
Do you get notified of that, or do you just need to keep a good note in your calendar?
You do not get notified of that. The onus of proof in South Africa, like the rest of the world, is on you. So you have to keep track of your records, and if you don't keep your records for 5 years, that's a criminal offence, like many other countries. We say to clients, please keep your passport copies, make a copy of it in case it gets stolen, get us to certify it. They don't accept airline tickets, but it's very important that you keep that passport. If you're going to work also whilst you are retired, which is allowed, you want to keep track of your work days in South Africa or work days outside South Africa. A work day in South Africa is taxable. A work day outside South Africa is non-taxable. The other part of the test is, and this is the one you have to be careful of, in addition to the days test, no matter how much time you've spent in here, if South Africa becomes your real or your main home, you're basically your domicile, you become ordinarily resident here. And that is then something that triggers tax residency from that day onwards. So if you arrive in South Africa and you say, I'm in South Africa now for the rest of my life, then you become resident on that day. And you immediately become liable for tax in South Africa on your worldwide income. And therefore, it would often perhaps be more wise to say, I don't arrive just here permanently and indefinitely. I will first see what it's like. Like most people which go to a country, first get a feel.
So exercise a bit of judicious flexibility here, I think is what you're saying.
Just be prudent in your approach. We've had so many cases of people that say they just want to spend a little bit of time here and then they want to end up staying here forever. And then you will have people that come to a place, they fall in love with it, they buy a property, they move in, and then they find after 4 months, listen, how it is to be on holiday in a place is different than what it is to live in a place.
Sure, yeah.
And we, being naturally conservative, say don't make that decision too quickly. Even if you want to buy a property, don't go and buy a property day one off plan. First rent, first see what it's like, that you make a well-informed decision. It's a big choice.
Try out different areas within different cities. Again, that's also being clever and prudent, isn't it?
We've got so many expats from Europe or US that stay in South Africa that loves Joburg because of the weather. We, as I think South Africans, we're so used to the weather. For us, it is not something special. But they say, no, if you are used to where we come from, this is wonderful.
All right, let's assume that you've made a decision. You've been prudent in your disclosure, and you have made a decision now that you're going to stay here for an extended period of time.
5 years.
5 years. How then does the whole tax residency approach impact on financial planning?
It impacts very well on financial planning. You obviously have to register for tax. When you register for tax, you have to register then as a category, which will be a non-resident. SARS would normally ask you some questions. Why are you non-resident? That'd be easy to answer. I'm on a retirement visa, for example. I'm going to work a bit XYZ. But they're only entitled then to deal with your South African source income. If you've got an international share portfolio, they're not allowed to touch it or tax it. If you've got an offshore bank account, they can't tax you on the interest. If you've got a rental property in the UK, US, or in Africa, they can't tax that rental income. The moment you become resident, of course, all of that changes. So that is why a lot of people that come to South Africa to retire, it's a great place to retire, but they obviously keep their financial interest and often business interest still international.
But what happens if you start to earn an income, even if it's from a small business, and it starts to become successful and it starts to grow? You would deal with that kind of financial planning scenario the same way that any South African would, and you would be subject to the normal rules of local taxation, I would imagine.
Exactly so.
Yeah.
Our rules are very much based on what I would call a British system that's gone around the world, or a Commonwealth system. You incorporate a company to run your business through. You have to pay sales tax or VAT. There's a matter of pay as you earn that you have to pay on your salary, like in most countries. A big benefit if you've got a small business and you earn money is there's no social security in South Africa. So if you go to a country like France, Canada, or even Mozambique, the social security charge is a very high percentage of tax. We've got no social security system at the moment in South Africa, but you have to pay tax on the money that you physically earn in South Africa. So you buy a property and you rent part of it out for rental income, you have to pay tax on that rental income. Of course, not the whole income, just on your rental profit. And then, like most countries in the world, we've got a progressive tax system. The odd first 200,000, slightly below that, you kind of odd 90,000 you don't pay tax on. Then just above 200,000, the next bracket kicks in. And so the brackets move up to a 45% tax rate. That sits at about 1.8 million rand, which is probably about $100,000, give or take.
We've looked at moving money into the country. We've looked at tax residency. Let's assume that you are now ready to make the start. I want you to talk to me a little bit about what people need to know about setting up the bank account and how you go about doing that. You've explained the difference between the two types of account that you need, but maybe the best way into it is, does the South African banking system differ markedly from other countries, and what should expatriates be aware of?
It pretty much is exactly the same. So the same old certified copy of a passport, proof of residential address where you are at the moment, source of funds, professional reference letter or two won't be an issue, it helps in certain cases, and you have to basically complete the form and state the source of money that's going to come in. These principles are globally determined, and South Africa falls in line with those global principles.
This is not a podcast about giving people investment advice, but at some point expatriates might want to start thinking about investing locally, maybe in equities, maybe they want to look at different funds. Philosophically, what kind of approach should they be taking in that respect against the backdrop of tax implication?
Even though I'm fully qualified and licensed to give any sort of investment advice in South Africa, we don't do it. It's not our game.
So the first thing you're going to say to me is go and find someone who can give you good advice. There are lots of people that'll do that.
I'm a bit tainted there because I believe often advisors advise what's good for them and what's not good best for always in the client's interest.
Jerry, that's a different podcast series entirely, I think.
But I think that as a foundational rule, if you can make an investment and not have to pay tax on that because it's outside South Africa, and it is squeaky clean. It's completely transparent, completely legal to earn tax-free money. It's even tax-free if you bring that investment money every month into South Africa. So, for example, the UK has got a thing called the remittance basis that says you only pay tax on the money earned outside the UK if you bring it into the UK. South Africa don't have a remittance basis. If you bring your foreign rental income or foreign interest income or foreign pension every month into South Africa, it does not become taxable. For me, a big decision is, why would you have a South African investment if making it South Africa you have to pay tax on that? That's one part of the equation. But you might have somebody that comes and retires and says, listen, but I want to buy a farm and run a farm. I've got clients like that. Or start an export business. So inherently, I will make South African money, and inherently, I will make that investment, and tax is a privilege to pay if you make a lot of profit. Then, of course, you must just structure your affairs properly. And like every place in the world, there's certain things that can be deducted, or a certain way of doing things which is more optimal than a different approach.
And same rules would apply if you want to externalize those funds as would be applicable to any South African wanting to do the same thing, or would it be different?
Exactly the same. You will fill in the same form. You will just have the non-resident box that you tick. But again, if you want to take money out, they will say, where does this money come from? Was it salary that I earned from a South African company? It was a dividend I received from my company, or I sold my property, or I sold my farm. Here's the proceeds. I want to take it out. They cannot keep your money in South Africa. A lot of people are concerned about that. They say that you cannot take out more than 1 million or more than 10 million a year. We've taken out, I think, our biggest client is well over 2 billion rand that we took out for individual. There's no limit on the amount that you can take out, provided that you are fully clean and disclosed on where it is from. Just something to add about the South African tax system is a lot of countries around the world, when you complete your tax return, allows you a lot of tax deductions because of behavior. You look after your parents, you get a tax deduction. You have got medical expenses, you get a big deduction. You have a mortgage, you can get a tax deduction for that. In South Africa, there's very, very few tax deductions that happen after you've earned money. So your planning should be that you should rather make sure that your expenses sits before you've earned it. But in South Africa, once you've earned it, your tax deductions is very, very limited compared to wherever expat might be coming from. They're often surprised to say, but surely if I have to look after my parents or a child, or I buy a property, or I give other people jobs, I should get a special deduction for that. Those things do not exist in South Africa.
So, final question, that is one misconception. What are the typical questions of concern that you are asked most regularly from expats who have arrived and are dealing with this sometimes very complicated process that you've outlined for us?
The most complex, I think everybody understands that the watershed is when you become a tax resident. It really is, what can they do safely to not overstep the mark and become resident? Because the moment you become resident or ordinary resident, you have to have an estate that covers your worldwide assets. You have to worry about capital gains tax planning. You have to worry about double tax because you pay tax in other countries. So it really is about planning for, if you are staying above the 5 years, when do you become resident? If you intend on staying longer, you must make sure that you have your ducks in a row and your planning done before you trigger tax residency. If you, for example, set up a trust whilst you are a South African resident, there is a whole host of anti-avoidance provisions which does not make it worthwhile for you really to set up that trust. But if you set up a trust before you trigger residency, none of those anti-avoidance provisions apply to you. It is typical international tax planning about having a roadmap, having a bit of foresight, and kind of not paying school fees on money that you've worked hard for.
Jerry Botha, thank you very much indeed. And that's where we're going to leave the discussion. Join us again for further episodes as we look at the processes and protocols for retiring and resettling in South Africa. Next time, we're going to look at immigration and specifically the retired person's visa.